Hey everyone, welcome back. I'm Justin Ankney with Mayhugh Commercial Advisors, and thanks for tuning in as we continue our market podcast series focused on Southwest Florida commercial real estate. Today I'm walking through the Collier County industrial market, and this is a particularly interesting one because it behaves very differently from the surrounding counties. This is not a supply driven logistics market, it's fundamentally a land constrained infill market, and that shapes nearly every trend we're seeing. Over the past 12 months, only about 38,500 square feet of new industrial inventory was delivered, while net absorption actually turned negative at roughly 252,000 square feet. Despite that, vacancy is still sitting around 4%, which is one of the tightest industrial availability levels in Southwest Florida. The reason is simple: supply is extremely limited, with about 14.6 million square feet of total inventory and only a small portion available. The market doesn't have enough new construction to materially shift conditions. Even when demand softens or tenants give space back, vacancy doesn't move dramatically because there's no wave of new product entering the system. This market is largely driven by small bay users and service oriented businesses, along with owner users that operate locally. And because industrial zoned land is scarce and development barriers are high, that structural constraint continues to support long term stability. From a leasing perspective, rents continue to trend upward. Average asking rents are now around $18 per square foot, reflecting continued growth despite slower absorption. Flex and specialized industrial product command the highest pricing, while logistics space trends slightly lower. Limited availability and rising replacement costs are key drivers behind that rent resilience. Looking at investment activity, transaction volume remains steady with approximately $100 million in sales across 75 transactions. The deal profile is consistent with what we expect here: smaller transaction sizes, averaging around 7,500 square feet, and a buyer pool heavily dominated by private investors and owner users rather than institutional capital. Pricing remains strong as well. Market pricing sits near $192 per square foot, with flex assets achieving even higher valuations. That reflects the continued desirability of functional small format industrial buildings in constrained locations. Another important point for investors is that buyer composition is overwhelmingly private capital, accounting for the vast majority of activity. Institutional ownership remains minimal, which reinforces the local, relationship driven nature of the Collier industrial landscape. Now, turning to development, or really the lack of it, this is probably the defining characteristic of the market today. There is currently no industrial space under construction, and the pipeline is effectively non existent. That stands in contrast to historical development levels and highlights structural limitations tied to zoning, land availability, and market orientation towards smaller owner user projects. Because of this, future inventory growth is expected to remain incremental, and that supply discipline is a major reason rent growth and valuation stability have persisted over time. So, stepping back, the overall takeaway is this: Collier County's industrial market remains stable and resilient, not because of explosive demand, but because of structural scarcity. Low vacancy, steady rent growth, strong pricing, and limited development all point to a market defined by constraints rather than expansion cycles. For tenants, this means planning early and competing for limited options. For owners and investors, it reinforces the long-term value of well-located industrial assets in supply-restricted environments. I'm Justin Ankney with Mayhugh Commercial Advisors. Thanks again for listening, and we'll see you in the next market update.